In today's financial landscape, credit scores play a crucial role in determining an individual's financial health. A good credit score can open doors to favorable loan terms, lower interest rates, and even job opportunities. For many wealthy families, ensuring their children have perfect credit scores is a priority, as it sets the foundation for a lifetime of financial success. Wealthy families often employ unique strategies to help their children build and maintain excellent credit. This can include adding them as authorized users on credit cards, which allows them to benefit from the primary cardholder's positive credit history. Additionally, some families establish trust funds or custodial accounts that help their children manage credit responsibly from a young age. The long-term benefits of having a perfect credit score are significant. It not only provides access to better financing options but also instills a sense of financial responsibility and independence. With a strong credit score, young adults can navigate major life milestones, like buying a home or starting a business, more easily. By understanding these strategies, viewers can gain insights into how to set their own children up for financial success in the future. Understanding credit scores. Credit scores are numerical representations of an individual's creditworthiness, typically ranging from 300 to 850. These scores are calculated based on several factors, including payment history, credit utilization, length of credit history, types of credit accounts, and recent credit inquiries. Each of these elements plays a vital role in determining how lenders view a borrower's reliability and risk. The impact of credit scores on financial opportunities cannot be overstated. A higher credit score often leads to better loan terms, lower interest rates, and increased chances of approval for credit cards and mortgages. Conversely, a low credit score can result in higher costs and limited access to essential financial products, making it crucial for individuals to understand and manage their credit effectively. Starting early in building a good credit history is essential for long-term financial health. Establishing credit at a young age, whether through secured credit cards or student loans, allows individuals to develop a positive credit profile over time. By making timely payments and maintaining low credit utilization, young adults can set themselves up for a brighter financial future, unlocking opportunities that come with a strong credit score. Early financial education. Wealthy parents often prioritize financial education as a key component of their children's upbringing, recognizing that financial literacy plays a crucial role in developing good credit habits. By instilling a strong understanding of money management from an early age, these families equip their children with the tools they need to navigate the financial world confidently. Many wealthy families utilize a variety of educational resources to teach their children about finances. This can include books on personal finance, online courses, and even financial workshops tailored for young audiences. Some families may also engage financial advisors to provide personalized lessons, ensuring that their children grasp complex concepts like budgeting, investing, and credit management. Encouraging parents to start financial discussions with their children at a young age is essential. Simple conversations about saving, spending, and the importance of credit can lay the groundwork for responsible financial behavior. By making financial literacy a regular topic of discussion, parents can help demystify money management and empower their children to make informed decisions. Ultimately, fostering an environment where financial education is valued can lead to a generation of financially savvy individuals who are well prepared for their future. Authorized user strategy. Adding children as authorized users on credit cards is a popular strategy among wealthy families to help boost their children's credit scores. When a child is added as an authorized user, they benefit from the primary cardholder's credit history, which can positively impact their credit score. This means that timely payments and low credit utilization on the card can contribute to a stronger credit profile for the child, even if they are not the primary account holder. Choosing the right credit card for this strategy is crucial. Parents should look for cards with a solid payment history and low utilization rates. Additionally, selecting a card that reports authorized user activity to credit bureaus is essential, as not all cards do. This ensures that the child's credit score reflects the positive behaviors associated with the account. To manage credit responsibly while using this method, parents should set clear guidelines for their children regarding spending limits and payment expectations. Regularly reviewing the account together can help teach children about budgeting and responsible credit use. By fostering open communication and accountability, parents can ensure that this strategy not only boosts their child's credit score, but also instills lifelong financial habits. Secured credit cards. Secured credit cards are an effective tool for building credit, especially for young adults who may be new to credit or have limited credit history. Unlike traditional credit cards, secured cards require a cash deposit that serves as collateral and typically becomes the credit limit. For example, if a young adult deposits $500, their credit limit will also be $500. This setup reduces the risk for lenders while allowing users to establish a credit history. One of the primary benefits of secured credit cards is that they help young adults learn responsible credit management. By using the card for small purchases and paying off the balance in full each month, users can build a positive credit history. Timely payments are crucial, as they directly impact credit scores and demonstrate financial responsibility to future lenders. Parents play a vital role in guiding their children in using secured cards wisely. Encouraging discussions about budgeting, spending limits, and the importance of making timely payments can help instill good habits. By actively participating in their child's financial journey, parents can ensure that secured credit cards serve as a stepping stone toward a strong credit profile and long-term financial success. Monitoring credit reports. Regularly monitoring credit reports is essential for maintaining a healthy credit profile and ensuring financial well-being. Accessing credit reports is easier than ever, as individuals are entitled to one free report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, every year. Families can visit annualcreditreport.com to request these reports and review them for accuracy. Identifying and correcting errors promptly is crucial, as inaccuracies can negatively impact credit scores and limit financial opportunities. Common errors may include incorrect account information, late payments that were made on time, or accounts that do not belong to the individual. By regularly reviewing credit reports, families can catch these mistakes early and dispute them with the credit bureaus, ensuring that their credit history accurately reflects their financial behavior. Encouraging families to teach children about the importance of credit monitoring is vital for fostering responsible financial habits. By involving children in the process of reviewing credit reports, parents can help them understand how credit works and the significance of maintaining a good credit score. This proactive approach not only empowers young adults to take charge of their financial futures but also instills lifelong habits that promote financial literacy and responsibility. Building a diverse credit profile. Having a diverse credit mix is beneficial for enhancing a credit score and demonstrating financial responsibility to lenders. A well-rounded credit profile typically includes different types of credit accounts, such as credit cards, installment loans, like auto or student loans, and retail accounts. Each type of credit contributes uniquely to a credit score, showcasing an individual's ability to manage various financial obligations. To responsibly manage different credit types, it's essential to stay organized and make timely payments. For instance, using a credit card for everyday purchases while ensuring the balance is paid off each month can help build a positive payment history. Similarly, taking out a small personal loan and making consistent payments can further diversify the credit mix. Encouraging a balanced approach to credit utilization is crucial for optimal scores. Ideally, individuals should aim to keep their credit utilization ratio below 30%, meaning they should use less than 30% of their available credit. This balance not only helps maintain a healthy credit score but also demonstrates to lenders that the individual can manage credit responsibly. By fostering a diverse credit profile, young adults can set themselves up for greater financial opportunities in the future. In this video, we explored the essential strategies for helping children build a perfect credit score, emphasizing the importance of starting early. Establishing good credit habits from a young age can set the foundation for a lifetime of financial success. We discussed various methods, such as adding children as authorized users on credit cards, utilizing secured credit cards, and monitoring credit reports regularly. Each of these strategies plays a vital role in developing a strong credit profile. We encourage viewers to implement these strategies with their children, fostering financial literacy and responsibility. By engaging in open discussions about money management and credit, parents can empower their children to make informed financial decisions. Together, we can help the next generation achieve financial independence and success.